Now we are going to move into the trading strategy section of this course. The simple trading strategy that I've selected is the 1-2-3 strategy for continuation trades and end of trend trades. First, we're going to look at the 1-2-3 pattern as an end of trend or reversal trading strategy, also called the 1-2-3 top and bottom pattern. The 1-2-3 top and bottom pattern is a very powerful pattern that signals a trend reversal. Remember, the market can do one of three things. It can go up, go down, and go sideways. And these are part of the market cycles. However, once the market moves up in a trend, at some point it's going to stop and reverse. And this is where this strategy kicks in. So as I said, the 1-2-3 top and bottom pattern is a very powerful pattern that signals a trend reversal. It can also be used as a trend continuation, which will be described shortly. First, the reversal pattern description. Scenario 1. In an uptrend, the market hits a new high labeled as point 1. Price then pulls back to a short-term support level labeled point 2. Finally, price moves to an area between points 1 and 2, right here, labeled point 3. It then reverses down again and begins a trend in the new direction. So we can see that it begins a new trend in the new direction because we have lower highs and lower lows. That's the definition of a trend, by the way. What's the trade entry for this trade? The pattern is complete when price trades below point 2. At a 1-2-3 top, the strategy is to sell on the break of point 2. The measuring objective for this pattern is the distance between points 2 and 3, projected below the breakdown at point 2. So that would be here. This is the measuring objective. The stop loss is set just above point 3. Naturally, once you add other factors like Elliott wave analysis or Fibonacci into your analysis, you will be able to select a better measuring objective. But this is the pattern measuring objective. So to keep it simple, you are certainly able to just use this pattern measuring objective. An optional sell is at point 3, but only if point 3 is at the 50% retracement level of the move from 1 to 2, and only when you see some reversal candlestick patterns. So if you are watching the market here, you see that we have a strong red candlestick moving down. You might place an entry right below the low of this middle candle, and then you're triggered before the break of point 2. So that's a choice that you as a trader have to make, whether you're going to trigger below point 2 or at point 3. This slide summarizes the 1-2-3 top and bottom trade. We just looked at scenario 1, which is the 1-2-3 top. Now we will discuss the scenario of a 1-2-3 bottom, right over here. Scenario 2. At a 1-2-3 bottom, the market hits a low. We label this point 1. It trades up to point 2, trades back down to point 3, and back up through point 2 to begin the new uptrend. And once again, the definition of an uptrend is higher highs and higher lows, so we see this market reversal right here. If 3 makes a new low, this pattern is no longer valid, and we have to start the 1-2-3 counting all over again. Some observations. I like to see point 3 retrace at least 50% of the move down from point 1 to point 2. I also learned that if the pattern has between 10 and 20 bars between points 1 and 3, it is more likely to succeed. A 1-2-3 pattern, in my estimation, isn't really valid if you have 3 candlesticks. Now, you could certainly move down to a smaller time frame to increase the number of candles between points 1 and 3 if you choose to. What I have to say about this is to back test it and see for yourself. I take most of my trades based on this pattern alone. It is very powerful because I like confirmations when I enter a trade. You can also use this pattern on a smaller time frame once the market reversal is identified, perhaps with other methods. You will get a closer entry point to point 1 and will therefore be able to take a larger position using the same money management rules, of course. So let's say this is an hourly 1, 2, 3 reversal. If you move down to the 15-minute chart, you would most likely see a 1, 2, 3 reversal inside of this 1, 2, 3. And you'd be able to take a larger position because you have a smaller stop loss. And I want to reiterate that you use the same money management rules. Whether you risk 1, 2, or 3% per trade, that's what I mean by your money management rules. Now I'd like to discuss some notes with you. The 1, 2, 3 reversal pattern is classified as a major reversal pattern and is one of the best indicators of a trend reversal. These patterns are found on every time frame and every market. So for example, the swinger position trader will look for these patterns on the weekly, the daily, and the 4-hour charts. The day trader will look for the 1, 2, 3s on the hourly and the 15-minute charts. The momentum trader or scalper will trade these patterns on the 5-minute, the 1-minute, and the tick time frames. Note 2. The stop losses for the 1, 2, 3 tops should be set above 0.1 initially, in the case of a top. And positions need to be sized accordingly so as not to exceed the risk limit for the trade. That's what I mean by money management. Another option is to place stops above 0.3. However, the odds are increased of being stopped out early. It is better to take a smaller position and leave the stop above 0.1. If you leave the stop above 0.1 rather than 0.3, the risk is a little greater, so the position has to be a little bit smaller. In the case of the 1, 2, 3 bottom, the stop losses are set below 0.1 or alternatively below 0.3. Okay, note number 3, and this is optional. On a 1, 2, 3 reversal using any time frame, wait 1 or 2 candles for confirmation. So let's look at the 1, 2, 3 top. Ideally, price will break down and then retest the breakdown point for a safer entry. And this helps to avoid whipsaw, but that's optional, of course. So this is the 1, 2, 3 pattern as a reversal trading strategy. Now let's look at some examples in the market to show this in practice before we move on to the 1, 2, 3 pattern as a trend continuation strategy. Let's move to live markets now. This is the Euro USD on the 15-minute chart. I highlighted the visible low on the chart, and this is a nice 1, 2, 3 pattern. 0.1, 0.2, 0.3. This looks to be between 10 and 20 bars. Once we take out the high at 0.2, the market moves higher. Scrolling to the right, here's a 1, 2, 3 top, where we label the top as 0.1, down here is 0.2, 0.3, and once we take out this 0.2, let's see what happens. This is the sell with the stop above 0.1. And price does eventually move lower. It does take a while. There is a bit of sideways consolidation prior to moving lower. Also, the number of bars between the 0.1 and the 0.3 seem to be between 10 and 20. There might be a few more candles. Let's look at another currency pair right now. Why don't we look at the dollar Canada? This is a 5-minute dollar Canada chart. We're looking at the high, the visible high on the chart. Until that time, there is no 1, 2, 3 reversal between 10 and 20 candles. This looks to be the first one. We can count the candles. 14 candles in this assembly. Let's label at 0.1, 0.2, 0.3. And we'll draw a horizontal line across the breakdown point. That would be right here. So this is where you would place your entry for a sell. And as you can see, this is a very nice sell. Moving down, we see a potential 1, 2, 3 bottom here. However, there are, I don't count between 10 and 20 candlesticks. This is the 5-minute chart. So I would leave this alone. We have 1, 2, 3, 4, 5. That's it. Okay, and we would have gotten triggered, of course, but we don't have enough candlesticks in the pattern, so we want to throw that out. Okay, and the market moves lower. Okay, this is an example where we have, technically we have a 1, 2, 3 reversal pattern on the bottom. However, let's see if price makes a new low here. It's questionable. The low is 125.67. The low here is 125.67. So we have an exact double bottom. That's a different pattern. That's a double bottom pattern. And you could buy above this level. Do we have enough candlesticks? 3, 6, 9, 12. We do. So technically you could buy, and you could call it a 1, 2, 3 reversal. However, the 0.3 is not at the 50% mark. Again, I like it to be at the 50% mark. Let's keep going. We make a new low. And we don't really have a nice pattern yet to take a trade. Let's see about this one. In this little cluster, we do not have enough candlesticks. However, we could consider this little pattern right here. We have about 15 candlesticks, so let's label that. And let's see what happens there. Okay. Okay, in this case, let's measure the distance between 2 and 3 and to see if the profit target is hit. It doesn't look like it is hit. Let's just measure that. And we'll paint this blue and project it on the breakout point. Okay, no. So let's keep going and see what happens here. All right, eventually the target is hit right over here. Okay, so that's an example on the dollar Canada. Let's move to another currency pair now. Here's the Australian dollar, the 1-hour chart. And if we look at the right side of the chart, we see the visible high. We can count these candlesticks to see if we have, this looks like a 1, 2, 3 pattern is setting up. 3, 6, 9, 10. So we have about 15 candlesticks in this pattern. Let's label it. 0.1 at the visible high. 0.2. 0.3. Notice if we look at this 1, 2, 3 pattern, we don't have enough candlesticks there to call this a pattern. So we have to wait. Do you see what I'm talking about? Right? Because technically we could put a 0.2 here and a 0.3 here or a 0.3 here. We don't have enough candles for it to make sense. Let's just put the trend line in at 0.2 and thicken it. And let's see what happens. All right, we trade sideways for a while. Let's see if we can get our profit target, and then the market moves down. So this is several hours going by before the move actually materializes. But if you leave your stop above 0.1, you just have to, be patient with this. A lot of traders might say, well, if it doesn't happen immediately, then I'm out of the trade. And that's your choice. But certainly if you do some other analysis with this, for example, Elliott wave analysis, which that's our expertise, then if you see the wave count and you see that this is a legitimate turning point, then you might be more patient because you would have more confidence as a trader to stick with your position. Let's see if there are any other trades setting up here. Okay, this is a 1, 2, 3 bottom, but again, we don't have enough candlesticks here to make that. Okay, this is a 1, 2, 3 reversal pattern as well, right over here. 3, 6, 7, 8, 9, 10. We have about 15 candlesticks in this pattern. Let's mark it out. And draw the horizontal line. Okay, let's see what happens. Okay, the market moves lower, so this was a good trade as well. All right, now we're going to move on to continuation patterns for the 1, 2, 3 continuation strategy. We've just completed the section on the 1, 2, 3 reversal pattern as confirmation of the end of the trend. However, while the end of trend 1, 2, 3 top and bottom is a great entry method for taking reversal trades, most of your trades as swing and day traders will be trying to get into a trend move, getting into the trend in the middle of it. You may have heard that the trend is your friend. So now we will learn a great method to get into a trend using the 1, 2, 3 trend continuation pattern. So how do you get into the trend in the middle of it? That's the question. The safest trades you can make are the ones where you are trading in the direction of the current trend. In other words, if the trend is up, you should be long. If the trend is down, you should be short. If you miss the start of the trend, you still need a method to enter a confirmed trend during its progress. I'm going to show you 2 entry methods using the 1, 2, 3 pattern for trend continuation called internal 1, 2, 3s. Method 1. Draw your 1, 2, 3 points as price moves in the direction of the new trend. Enter on a break of the newly established 0.2 with the stop above 0.3. Follow the market up or down depending on the trend. So now we would relabel this next move as 0.1, 0.2, 0.3. You really don't have to relabel the 0.1. You have to know that the new 1 is the old 3. And sell on the break of 0.2. Here's another one. The new 1 is the old 3. 0.2, 0.3. Sell on the break of 0.2. Method number 2. Draw your 1, 2, 3 points. Enter at 0.3 once price turns down with a stop above the new 0.1. So here we would enter at 0.3 with a stop above 0.1. Here we would enter above 0.3 with a stop above 0.1. Now here we would enter at 0.3 with a stop above 0.1. Now in this case, we don't quite have between 10 and 20 candles in the pattern. I only use that rule for the 1, 2, 3 top and bottoms that we have between 10 and 20 candles. But for the internal moves, sometimes the reactions are very shallow and the move down is very strong, as you can see here. So you don't necessarily need to follow that rule. In fact, I don't use that rule for the internal 1, 2, 3s. So 2 entry methods, break of 2 or 0.3 pullback once price turns around, and you might go to a smaller time frame as well, if that makes it easier for you. Exit at the point 2 to 3 distance projected below the break, or trail the stop candle by candle. So you can measure the distance and project it and take your profits, or just trail your stop, move your stop down as price goes down. And you can trail your stop 1 candle at a time. It's probably better to use a 2 candle trailing stop. So what that means is, as soon as price breaks down through the 0.2 and we have this second candle, you immediately move your stop 2 candle highs back. And I realize that this is a long candle, but as soon as we have this next candle, this green candle, your stop is already down here. In actuality, this could be a method to add on to your positions, so you don't have to necessarily take your profits when the trend is happening. You can add to your positions as long as you're moving your stops down and you're not increasing your risk and you're taking profits. Hypothetically, by moving your stop, you can add to your positions in this fashion. We will discuss that in more detail in the notes. Here's another example, and this shows the 1, 2, 3 reversal pattern, the 1, 2, 3 top kicking off the sell, followed by a 1, 2, 3 continuation pattern. Now let's talk about discuss some notes. 1, when the trend is your friend, we need to make sure we get into the trend at various points along the way. Why? The safest trades are taken in the direction of the current trend. Trade entry is easily done with the internal 1, 2, 3 formation. 2, in a trend, the first 1, 2, 3 pattern is the reversal pattern that occurs at market tops and bottoms. The second and third set of internal 1, 2, 3s continue to confirm the uptrend or the downtrend. 3, take note how each 0.3 becomes the new 0.1 for the next internal 1, 2, 3 pattern. In a very strong trend, 0.3 will not always retrace to at least the 50% mark, and that's okay. It's more important for that to occur with the reversal 1, 2, 3s. In a strong trend, the retracements can be as shallow as 23.6 or 38.2 or even less. Note 4. If you miss the initial reversal 1, 2, 3 pattern, look to get into the subsequent internal 1, 2, 3s. Preferred entry is on the break of 0.2. However, alternatively, you may enter at 0.3 and wait for the candles to start trending again before entering. Note 5. Profit taking is recommended along the way for day traders. Position and swing traders may hold the positions and trail the stop every time we trigger a new trade. The stop would then be placed above the new 0.3, which is the new 0.1, and previous stops would be moved to the new 0.1. These positions would be considered add-ons for position and swing traders. Now let's look at the markets for some examples. We left off on the Aussie dollar, looking at this hourly chart and seeing this 1, 2, 3 reversal pattern. Now let's move to the 15-minute chart because I want to illustrate. I see an earlier 1, 2, 3 reversal pattern right here, but we have to move to the 15-minute chart to see that to get enough candles in. And this is a good example of getting a better trade entry. So by moving down to the 15-minute chart, you would be entering at 79.82 versus entering at 79.40. So a savings of 42 pips, which would enable you to take a larger position because your stop loss would be smaller. Your stop loss from 79.82 to the top of 80.25, do the math, is about 43 pips, okay, plus spread, versus a stop loss of from 79.40 to 80.25, 85 pips. Let's move down to the 15-minute and see what I mean here. Yeah. Notice this is the new 1, 2, 3 reversal pattern. We have between 10 and 20 candles here, and this illustrates getting a better entry. Okay. Moving along, let's look at this 1, 2, 3 continuation trade in the direction of trend. So we're already in here. Now we want to look at add-on positions for the continuation trend. How are we going to label this? Why don't we label this a little bit differently? Let's move these numbers off to the side. We'll move them off over here. And actually, let me just delete, well, we can leave them there. And these numbers are now going to represent the number of trades that were taken. So let's just say that we took our first trade here. Then price moves down. This is the new 0.1, 0.2, 0.3, but we never really come down. Price moves up, so this is a 0.3. Let's stick with the game plan and just relabel this as the new 0.1, the new 0.2, and then you would set your trigger right there, and this would become the new 0.3, but the new 0.3 would have to move, right? Initially it's over here. We don't take out 0.2, so then it moves, and it moves to over here, which is fine because this is a continuation trade. So this is our second entry, and let's keep going. Okay, here's another one. So that's our second entry. Here's another one. This becomes the new 0.1, 0.2, 0.3. Let's put our horizontal line there and see what happens. Okay. Okay, so we're triggered there. That's our third trade. Let's keep going. Oh, I missed this one. I missed labeling this one. Okay, here's the new 0.1. Remember, 0.3 becomes 0.1. This becomes 0.2, and then we move up for 0.3, so we have to put another horizontal line there. I must have been sleeping for this one. And we get triggered here. Let's label that the fourth trade. So you get the picture. We have a lot of things going on, and this is a 15-minute chart. So, and this is over several hours, and you don't have to take all the trades, of course. But the one thing that you have to remember is if you are adding to your positions, you need to move your stop losses. If you're taking fresh positions, which is fine, you treat each position separately, and then you manage your position accordingly. So you set your profit target for each position. So two choices as a trader: you can either add to your positions, making sure to move down your stop losses to the new 0.1, initially all the stops, or you can trail your stops bar by bar or candle by candle, or two, you can treat each 1, 2, 3 continuation pattern as a separate trade. So this is a good example of how we find these patterns in the markets. They happen on any time frame. They happen across all markets. And why do they happen across all markets? Because the markets patterns repeat themselves over and over again. That's the fractal nature of the markets. So now let's move back to the presentation. And this concludes the mini course. So the Forex market offers an opportunity to trade various currency pairs and CFDs as well, as we've described. Once a trader understands that all of the markets are related in some way, currencies, commodities, and stocks, and that correlations exist between certain markets, the excitement comes in understanding these relationships in order to confirm market moves day in and day out. So learn the fundamentals, scan the markets for the best markets to trade, and select a simple strategy such as the 1, 2, 3 strategy to stay with the trend or find the end of the trend for the market reversal.